Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.
Welcome to Stockwatch with me, Simon Brown, and joining me to unpack your stock-related questions, Schalk, PSG Wealth Old Oak, Gary Booysen, Rand Swiss. Be sure to send your questions via email stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV, #Stockwatch. Gents, thanks very much. The big story, of course, gold above $4,000. I'm not going to ask you where it's going because I haven't a clue, although I did. From when Nixon took the US off the gold standard to the peak in the early 80s was a 20-fold increase. So this might be early days. But Schalk, you've been running some numbers. If I didn't have gold in my portfolio, the JSE is not so pretty. It really is a golden index this year.
Yeah, that's an understatement, Simon. But just your first point, I loved your intro today. You said, well, if you want to ask me where gold is going, I don't know. Yeah. I mean, but clearly somebody's knowing, because I saw a report yesterday that came out from Goldman Sachs. I don't know if you've seen that. Now, they're the same company that brought out. Simon, I think it was our previous discussion, or maybe the one before. So it's about, let's call it 3-4 weeks ago. Mm-hmm. They brought out the report where they said they actually seen the gold price surpass $4,000, by the first quarter of next year.
Yes.
Now you just mentioned it. We've dusted. Brought out a report yesterday where they said, well, we had a forecast of $4,300 by year end next year. We now see gold price at $4,900 by year end next year. So, I mean, we don't know where it's going, but clearly Goldman Sachs, no. But to your question, I mean, I found it extremely fascinating, because here we're sitting. I mean, up to yesterday's close, JSE is pretty much giving you a return of just shy of 34. Let's call it 33.7%. Mm-hmm. Now there's just 5 gold counters in the JSE. Let's add Sibanye to that mix, because we know more than 50% of their profits are now generated through gold. So I made them a gold counter again. If you strip out those gold counters, your 33.7% would have dropped down to 18.9%. So I said, well, okay, let's take that further. Let's take out the 3 real pure PGM counters. Let's take those 3 companies out as well. You pretty much would have yielded a return of only 15%. So I had a very, very interesting question on X, literally just now, where an individual asked me, said, well, can you do me a favor, just exclude Process and Naspers as well, just for shits and giggles. Let's just have a look at it. Came back, if you excluded those 2, you would have dropped down another 8%. Your total return for this year would have been only 7%. So it's crazy to think that's 10 counters, 11 counters, pretty much giving you most of the return for this year. So just shows you again, never be very careful excluding certain companies out of your portfolio, because sometimes it's a very, very difficult. How does the saying go? Gold, you're making me old.
Yeah.
Only if you don't have it. Only if you don't have it.
I didn't have gold forever in a day. I'm a late gold boo. Gary, the trick is, what do we do with our gold stocks that are looking beautiful? Do we take some profits off the table? Do we just close our eyes? I mean, we're certainly not shorting, and I don't want to sell them all either.
Yeah, I mean, it's a great question, and all of it is determined by where the gold price goes. And I think it was Adrian Saville was saying, he's done a back of the napkin calculation that if we had to return to like the pre-fiat world, and we had to back every dollar if we had to back every US dollar with the gold that's available to the US at the moment, I think the gold price has to be $101,000 an ounce. It's definitely the highest estimate that I've seen on gold. So I mean, there could be a long way to run. Who knows? I think from our point of view, I mean, it does tend to be very cyclical. I think the tailwinds around the gold industry are certainly still there. I mean, we're seeing central bank buying, coming through in a big way. It doesn't seem to be slowing down. It does seem to be a de-dollarization at this stage. And I think everything is looking good in US dollar terms. So, can there be more to go? Absolutely, but I would be cautious. I mean, we've actually recently exited Sibanye-Stillwater. I mean, we're sitting on a 260%, I think, year-to-date movement almost on the counter. For us, it's time to reassess and deploy elsewhere. I mean, I think we've talked about it on the show. I think there were times when I kind of, always discuss gold in the three ways you can own gold, and I kind of explain to people, like, you've got to understand why you're owning gold as well. Are you owning gold because you're scared that the financial system is going to collapse, and this is going to be an alternative form of money because the banking system doesn't exist? Then your ETFs are not going to help you. Then your gold miners aren't going to help you. You need to go and buy the physical. You need to go buy Krugerrands or bullion or whatever it is. If you're looking to trade it, gold counters are fantastic. I mean, they've got that operating leverage. You get the exaggerated movements. But if you are just looking for a market hedge in a time of uncertainty and you don't want the hassle of physically transporting the gold around, the Absa New Gold ETF, for example, is a fantastic way to access it. Now, I remember talking about, I think gold was at $3,100 an ounce, and I almost got spat on the show. And I think these things they go in cycles as well, and I think you do have to take a little bit of a contrarian approach. And when something is running as hard as it's running now, just a little bit of caution, a little bit of skepticism. As you say, I would be way too scared to take a naked short in the gold market at this stage. We just don't know. But when you're sitting on a lot of profits, and essentially the miners at the stage, they are price takers. If the gold price falls back for whatever reason, they're going to get hit very, very hard. And I think given where the gold price is at the moment, I think these miners are looking full. Of course, if gold goes to $5,600, $6,000 an ounce, the gold miners will keep running. But I'm happy then to watch from the sidelines.
Yeah. Just a quick chip in. Simon, I just want to quickly chip in, and we don't make this just a gold show. I think to add to what Gary said. I mean, yes. I mean, it's difficult, but we haven't been here. We haven't been in this scenario. I mean, in the, let's call it 30, 35 years I've been on the market, I mean, I've never seen gold miners not sitting with any debt. I haven't seen the gold miners sitting and creating this amount of cash flow that they've done, ever before. And just remember, when you look at these miners, and I'm talking about our miners, the 5 pure gold miners on our JSE, they're all in cost and all in sustainable costs, anything between $1,700 and $1,900. Let's kick it up and make it $2,000. so at $4,000, these mines are printing money. So suddenly the business case for a miner, it's somebody once made the observation that gold is not something you invest in, you trade it. But now suddenly these mines are extremely positive in terms of cash flow, in terms of very little debt, in terms of profitability. I wouldn't be in too much of a rush and too quick of a rush to be selling my gold. And as Gary said, to try and short it at current levels, hey man, that will take only the bravest of brave.
Yeah, look, my grandfather was in the bucket shops in West Street, Durban, trading gold miners in the 70s, and he sold his first bunch at $350, got back in at $550 and rode it to $850. And his lesson to me was, when gold runs, don't leave it, just like stay on and hold on tight. But I think he got lucky at the 850 point. That was always my point to him. How did he know about that? Gary, let's touch on Data Tech. It's a stock that, I mean, I still remember the 140 Rand Deutsche Bank expose. I remember it was 2000 and someone let some data go and there was all sorts of problems, insider trading accusations. Not one I watched, but a good update out of them yesterday. Had a good year so far. Is Data Tech a stock we should be paying closer attention to?
Well, I think the returns have been pretty good out of Data Tech. It's also one that kind of sits on the sidelines because if you look at it, I mean, it is fairly tightly held. I mean, Jens Montanana has, roughly 18% of the business. PIC's got another 16.5%. And one of the asset managers also sitting at about 15%. So it's an interesting one. I mean, it's well diversified. It operates across 50 countries, 11,000 customers. It's not particularly expensive at 15 times earnings either. And they've also, they've got a dividend payout ratio. I mean, they measure underlying EPS, which basically excludes, like impairments to goodwill, P&L on investment assets, fair value moves on financial instruments, a few other things. And it sits on a fairly decent historic dividend yield. And now you've got obviously that trading statement that that came out recently, looking at your earnings per share up probably more than 100%. So you can expect probably that dividend to be lifted quite nicely. I think my issue around it is, ICT is a very complex business to invest in. They specifically, through their at least Westcon International business, they look at security network technology products, and this is essentially reseller partnerships and implementation agreements for people like Cisco and Palo Alto. And I think, while these are best-in-class solutions and they are quite optimistic, the ICT landscape is changing very quickly at the moment. We've got this big kind of drive into AI. The way that traditional business models might not work in the same way as they did in the next 5 years than they did for the last 5 years. And I mean, this is a business, sure, they've been around since 1986, but just with I think the disruption that's happening in ICT and specifically around the reseller models, I think there's potentially an outsized risk, and maybe that's why you can get a company like this at 15 times earnings.
Yeah.
But I think that the complexity of the industry at the moment is kind of a little bit of a red flag to me. But that said, I mean, hats off to management, and the business is performing exceptionally well. It's well diversified. It's got US dollar earnings. There's a lot to like about it as well.
Yeah, absolutely. There totally is. And when I referenced that insider trading, it was 25 years ago. We need to remember that as well. Schalk, some data tech for you in a minute before ad break.
Yeah, I'm going to make it quick. I mean, Gary covered it very well. Just nice to see the double D's back. I mean, one of the D's are gone, Dimension Data. We know. Remember this is now 2000s, and another company that's been one of the hot topics 20 years ago when we had that tech bubble was data tech. So it's nice to see them back, and any company that's forecasting to grow their hips by 100%, that definitely attracts my attention, attract the market attention. I mean, the movement that we've seen yesterday was over 11%. Today again another 4%. Year to date we're sitting at 100 baggers. So I think it's great to see, and definitely something I'll be following.
Yeah, and it is. I mean, it's trading at 70. Back in 2000, it was trading at 140. Although that was a very brief window. But I remember Datatech got to 100 and delisted at 13. Question coming through. Optasia. They put a sense out this morning. They're going to IPO on the JSE. EPE Capital Partners has a stake in them. And I only know about them because sometimes we get, there's a Graham Kerner who comes on and he loves EPE. Schalk, Optasia, do you know anything much beyond the sense this morning?
Beyond the sense. No, that I read of the sense. Naturally, I went and looked at a company, and I mean, firstly, we're looking at a over 6 billion rand IPO. So this is by no means a small listing. Really, really interesting business model, and they work really, really close to the likes of the MTNs, Vodacoms, also some of the banks, where they actually look at these they offer these microloans, airtime credit, and those kind of things. But where it gets fascinating is that how they use AI to take these data points and to look at the credit worthiness of some of these clients. So. Yeah, I think I want to pull the clock back, to a Capitec back in the day. Don't want to, say it's the same type of company, but also very similar in the microloans area. You mentioned the EPE Capital. You know my love for holding companies. Yeah. So this is something where some of the individuals can maybe have a look, because when you look at this company is currently trading at a NAV, let's call it R8.57. So at the current trading price of R7, that's about an 18% discount. And when you look at Optasia within EPE Capital, it makes up around about over 50%, 51% of the total portfolio. So that could be a nice entry. And we know that there's been some rumors, for many, well, actually years, about TimeBank. They also own, TimeBank. So by looking, if you're interested in getting this Optasia, you could maybe look at EPE Capital as well. And then you get the added bonus of getting TimeBank as well. Not something that I own, definitely something I'll be monitoring. Like I said, it sounds like an interesting business model. Yeah,
it was. I mean, Graham Kerner has been saying that, exact to your point, that unlock of value, that discount to NAV. Gary, do you have any deep insight except that it's fun to have a new listing?
Well, it's definitely going to be fun to have a new listing, but I think I was looking at it in the SENS announcement. So, yeah, I kind of look at it, and you kind of always ask, like, what is the purpose of a listing? The listing, yes, I mean, absolutely, it's going to, we're talking about it on TV at the moment, so it helps bring the company to the forefront of investors' minds and users' minds, and there's certainly a big reputational aspect to it as well. Of course, you need to raise capital, but it's also an exit strategy. And I mean, EP Capital Partners is a private equity firm that, yes, it's listed on the JSE, but this does look like it's exiting. And when you read about fintech firms, and everything is AI this and AI that, you start to go, oh, are we seeing that the smart money is selling into a bubble? And that's the skeptic me, just in the back of my mind, thinking about it. But I mean, the fact is, like, the revenue line is growing very, very quickly. I mean, they've done $117 million for the half year in 2025. They're servicing 121 million monthly active users. They're processing 32 million loan transactions per day. So this is a real business. Now, to Schalk's point, they're raising 1.3 billion rands worth of capital. So that will be kind of like the IPO. But the idea is to do then a further private placement of 5 billion, and that those funds are not going to flow into Aptasia. That is an exit strategy for EPE. So maybe the better way to play it is to go into EPE. Maybe this is an excellent exit, but like I said, I've started looking at this today. I mean, and like I said, like, whenever you're looking at these things, you've kind of got to question why the IPO, what's going on, what's the exit strategy, and I don't know if I can really speak to that. But I mean, we're also talking about a company, that is essentially going to raise or transact in over 6 billion rands worth of capital, a company with 356 employees. This is not a particularly employee heavy. I know they're capital light business. But yeah, I think have a look at it properly, and I think the idea of seeing more companies like EPE coming to our market is also very exciting. Not just getting a nice AI-driven fintech that we can go and trade, but the idea that a lot of the benefit is generated within the private equity space these days, and it's something that retail investors don't really have access to. It's difficult to get access. So entering via EPE into a private business where as you say, you can kind of benefit from Aptasia. You're not going to get kind of the full run up. But I mean, inside there's all sorts of other businesses. So Schalk already mentioned Time Bank. It's got obviously with its strategic partnership historically with Break, there's a lot of kind of like the Break links in there as well. But I mean, also an entry into something like MTN Zakhele Futhi. So yeah, I think an interesting business, but I would need to do more research to really give you a feeling on whether we're going to be kind of staggering the listing or not. But yeah, this is a main board listing. It is a big listing, and I think it's going to be exciting.
Yeah, but I take your point.
Diplomatic. You're so diplomatic, Gary. Come on. When do you do a listing? So that's
an exit.
There's a 101 plus. Yeah, firstly, that's that you've said it. When do you want to exit? When everything is high. So they've got the buzzwords. The buzzword AI. I mean, they use AI to do
a lot.
And then when you look at the environment that is predominantly, the environment they're trading in is the cell phone industry. And when you look at the cell phone industry year to date, all of the cell phone counters, the MTNs, the Vodacoms, the Telcoms, all those companies are also finding itself in the top 15 best performing asset class or companies for this year. So this will be let's call it the perfect time to be. I don't want to use the word exit again, but this will be the perfect time to do a IPO, to do a listing. So it's totally understandable. I agree. I mean, definitely, you look at the holding company entry. That could be a nice one to be.
Well, and because they're going to get a chunk of that 5 billion, which is the exit, which is perhaps the key point. And someone on Twitter, and I really liked it, they said, you know what, 3 years ago we would have called it machine learning. Now it's AI, it's all the same stuff. But AI is much more the hip word these days. Gary, question coming through around Hyprop. Worth looking at is to invest into. They focus on Eastern Europe and Western Cape. And of course, I think they raised some capital for that Mass PLC deal, which didn't happen. Hyprop, one that interests you. They've sold half of Hyde Park. They'll sell the other half in a couple of years. Thoughts?
Yeah, so I think, I mean, we were chatting about it also probably about 2 years ago, the idea that, with interest rates coming down in South Africa, the listed property sector should pick up. And it took a little bit of time, probably six months to a year, but then suddenly listed property on the JSE is one of the best performing sectors around.
Yeah.
I think kind of my fear around high prop is, again, it's almost a long-term structural fear because we, typically in our local equity portfolio, it's not a massively active trading portfolio. We're trying to buy good quality companies at a discount, hold them for the long term, and you need to be able to then ride through, I suppose, structural changes to the industry. So, with Hyprop being such a retail-focused business, like Eastern Europe, I have no problem with Eastern Europe. I mean, the economies are growing quickly. I mean, if you go to the likes of Bulgaria, Croatia, I mean, development there is accelerating. You can feel it. There are cranes. It is an exciting geography, and I don't think I have as many fears around Eastern Europe, which accounts for about 33% of their revenue as maybe other people do. But as you said, Canal Walk, Rosebank, the kind of traditional mall structure in South Africa. I mean, we're moving into a world of online retail. I mean, do you need are these shopping centers just going to become very expensive warehousing space for 60/60 drivers? I think there is a structural shift here, and I don't know if we're through it yet, where these retail shopping centers become more places to congregate, restaurants. It's more kind of an entertainment venue rather than like the more traditional retail venue. And I think that change is going to continue happening. But that said, interest rates are falling. We have liked the listed property sector for a while now. We didn't get the Reserve Bank cut that I was hoping for.
Yeah.
But yeah, from all indications from the SARB, the terminal rate is probably going to be lower because they're very focused on that kind of 3% inflation figure. That should be good for property investments in South Africa. So yeah, I wouldn't say I'm necessarily flagging high prop as a sell. I just think maybe better things in the sector that I would look at.
Schalk, I've got to go to stock picks, but in half a minute, have you got much to add to high prop?
It's so well covered. No, I mean, I like the focus. I mean, the focus.
Yeah.
I'm not invested, so I can eat. I mean, they've made it very, very clear, despite let's call it the Eastern European side. I mean, the South African side, they're focusing on the Western Cape, and that's been a good strategy. When you mentioned Canal Walk, but there's also the Sunset Mall. They've got Cape Gate. They've got the Table Bay Mall, and the most important thing. I mean, if you've seen since COVID how these vacancies actually reduce, just showing you again, there's definitely some interest in these retail properties, and I don't think that's going to disappear anytime soon. So yeah, I think there's still some opportunity in some of our local property counters, and definitely not one I'm invested in, but will be monitoring as well.
Okay. Yeah, I do all my property through an ETF because I just find it easier and it gives me more time to look at my gold holdings. But let's go to some stock picks. LVMH, Schalk, you're going luxury.
Yeah. I mean, I had it as my stock pick 3 weeks ago. So anybody switching on Stockwatch now thinking is looking at 3 weeks ago, it's not. I'm reusing my stock pick, but for a very good reason, because they're actually bringing out results tomorrow, and I think that'll be an interesting one. That's one of my tech guys back in the office looking at it, and he gets really excited on a technical basis. So it does look interesting, and I think if a surprise comes through tomorrow, and some of these analysts are getting a little bit more upbeat on some of these luxury goods, LVMH relative against its historic PEs is not looking expensive. It has always been a high PE, or to call it a high growth type of stock or quality stock. I do think watch this space. If the results come out better than expected tomorrow, don't be surprised this company flies.
Yeah, and it is that chart is looking pretty from my very, very limited charting ability. Gary, triple index auto call.
Yeah, so this is, as I've chatted about these quite often on the show. So we're building one for, I think it closes the 22nd of October. And essentially what these give you is a fixed coupon in return for, taking on some equity market risk and some credit risk. So the coupon at the moment we're pricing at 12% in US dollars, which is, you're probably looking 3% above the long run average of the S&P 500. It links to the S&P 500, the Nikkei, and the Euro stock. stocks. And as long as all of those indices are positive at an observation date, there's 9 observation dates over 5 years, you'll get that 12% US dollar coupon. It's fully offshore as well. And I think the reason that I'm looking at it at the moment is, I mean, we've got markets at record highs here, in locally and offshore. Offshore driven totally by this AI boom. You strip out, kind of the Mag 7 and things are looking a little bit shaky. The Mag 7 starts to shake, you could easily see a pullback in global indices. At the same time, the South African market, Schalk was talking about it earlier, it's driven by the precious metals, also can be very, very shaky. So if we go through a period where we do see sideways or flat markets, let's say that we get a 20, 30% pullback at the index level, and it takes 3 years to recover. If you've invested directly in those underlying ETFs, you're essentially going to be flat over 3 years. Where this, you would get a simple interest coupon of 12% in US dollars. So you're looking at a 36% dollar return in a market that is essentially flat. And that's where this product really stands out. And we believe that they're a good diversifier to a portfolio that is more exposed to equities. And of course, we also give 30% capital protection as well. So it's just something that I do think is, given where markets are trading now, I think risks are a little bit elevated, and also with the idea that interest rates are going to come down, a coupon at 12% at the moment is actually pretty high, especially if you can lock in, because you're not going to get coupons like that, let's say in a year's time, if the Fed has cut another 2 or 3 times.
And importantly, a US dollar, which is an impressive. But we'll leave it there. That's all for Stockwatch today. Thanks to our guest, Schalk Louw, PSG Wealth Old Oak, going with LVMH. Gary Booysen, Rand Swiss, the triple index auto call. Up next, the close.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.